Hello and welcome to the Power Your Advice podcast. The Power Your Advice podcast is designed to bring financial advisors new ideas, why those ideas should be considered, and how to implement them into your business. This podcast is brought to you by Advisorpedia, the best place for advisors to grow their minds and businesses. And now, please join your host, Doug Heikkinen.
Hello and welcome to the podcast. Today we have the founder and president of Lakeview Asset Management, Scott Rothbort. Scott has over 35 years of experience in the industry with stops at Merrill, Morgan Stanley. He started Lakeview in 2002. Scott appears frequently to spar on CNBC, Bloomberg TV, radio, and Fox Business Network. Welcome, Scott.
Thanks for having me today.
How's sparring on those networks, by the way? You enjoyed that, don't you?
I do. You've got to keep the guests on their toes, and they like to keep me on my toes, and I stand my ground when necessary.
So let's start with new beginnings. You expanded your business to Las Vegas. How's life in Vegas, and why'd you pick Vegas?
Las Vegas is wonderful. My wife and I were looking for a future retirement spot and vacation spot. But we wanted something in warm, dry weather. And Florida just didn't fit into that. Originally, I was actually looking in Scottsdale, Arizona. As it turns out, during the looking process, our fourth child, Stephen, was admitted to the Harris School at UNLV, which is the Hotel and Hospitality School there. So he winds up going to Las Vegas, and my wife and I said, well, the weather's the same, except the food's better and the entertainment's better.
Sure is.
And so let's look in the Las Vegas area. And we wound up buying a very nice home in Henderson. Stephen lived in it while he was at school. And then my wife and I, again, used it as a vacation home for many years. And then finally, we made it our permanent residence, but still keeping our homes back east in New Jersey and in upstate New York by Lake George.
There's also new beginnings for your business, but we'll get to those. Let's back up and talk about why you chose this profession.
That's a great question. I come from a family, my mother's side of the family are all PhDs, medical MD, PhDs, biochemists, a little bit of psychologists in there, also very artsy people. My father's side of the family is mostly lawyers and some business people. My father unfortunately died when I was 15 years old. And I was going to Stuyvesant High School, and I had to make a decision as to what I want to do. My mother's side of the family said, well, Scott is going to get his PhD in mathematics. And my father's side of the family said, no, Scott is going into the business world. And I sat down with my older cousin, who happens to be an attorney. And I was back in the days you used to buy the Barron's College Guide, which was about 20 pounds. And we went through it. And, we picked out some schools, and he just turned to me and said, Scott, well, what do you want to do? I said, well, I want to go to business school because, frankly, when I go to a mall, I don't see any math stores there, but I see plenty of other stores I can use an accountant or a financier. And he said, okay. He said, so, where do you want to go? I said, well, I'll go to the Wharton School of Business. We closed the book, and I applied early decision to the Wharton School of Business, and I got in.
That's great. But Wharton School of Business, picking financial services, there's got to be some breadcrumbs between the two.
So this is 1977. And I was always interested in investing. And, through family who invest in the stock market, I used to read the New York Times business section, which back then had a very extensive stock listing. And I used to read the New York Times all the time back then. So I was familiar with stocks, and I was familiar with some stocks, and I even picked out some stocks with my bar mitzvah money, I remember. And then when I was in college, unfortunately, my father's father passed away, left me some money, and I invested it in some stocks, some of which I still own today, believe it or not. One was Philadelphia Electric Company. I let the dividends reinvest over the years, and finally, I don't know, about 15 or so years ago, I sold some of it to rebuild the kitchen in our house in New Jersey. But it was worthwhile, and also when my wife and I got married, we bought our first house. My wife was a real estate attorney, so she's filling out the application. She said, "Well, how much are we putting down? 20%?" I said, "No." To my wife, I said, "Lainey, we put down 50%." She looked at me like I was crazy. I said, "Trust me, we're going to put down 50%. You're going to be much better off for it." And we did. So, no math stores. In 1977, it was the Carter years. Things were not very good. Wall Street was dead. Okay, It had been dead since the late 1960s. So I took maybe the safe route, and I decided to go into accounting. And I studied accounting as an undergraduate at Wharton, and economics. And I went to work for Price Waterhouse for 2 years. But while I love accounting, and I love the accounting theory, when you go into accounting, you wind up going into auditing, and auditing just wasn't for me. Well, I got a break, and all of a sudden, Wall Street did open up in 1982, 83. So after 2 years at Price Waterhouse, I got a job at Morgan Stanley, and the rest, shall we say, is history.
How many teachers did you have along the way that influenced you?
Well, I had several. Teachers, mentors,
Yeah.
a bit of both. When I was in high school at Stuyvesant, it was always a math and science oriented school, very well known. And I had a particular math teacher there who was a big influence on me. His name was Mr. Ritterman. And he just, he always pushed me to that next level. And it's funny, I found my high school yearbook. In it, I had folded over in there a whole bunch of math quizzes. And I looked at this and I said, "My God, I have forgotten so much mathematics in the last 40 years." But he was certainly very important. I also, believe it or not, had another teacher who you may know. He was a famous writer. And he was also in charge of the stage productions of schools. But he had some public speaking classes and debating classes, and I took it. And he went on to write a book by the name of Angela's Ashes. And he was one of my high school teachers. In college, in graduate school, I had the great opportunity to study under some wonderful minds. I love to tell this story, so you'll have to indulge me. When I was a junior, I had to make a decision as to whether or not I took a course in finance or I took an advanced economics course. And so I decided not to take the finance course, and the finance course was taught by a very famous finance professor who was always on CNBC and Bloomberg and whatnot. But instead, I wound up taking an economics course. By the way, his name was Jeremy Siegel. And instead, I took this economics course, an advanced economics course with this young professor. The term project was that we were supposed to forecast a whole bunch of economic variables, such as the inflation rate and the 10-year U.S. Treasury rate and all these other things that nowadays we're always reading about in on Bloomberg or the financial press. And this was back in the days before you had laptops, before you had the internet. So you had to go to the library, or we had to go to the Federal Reserve in Philadelphia or New York, and really do some hard work and scratch things down on pad and paper, and then they did have mainframe computers, so we were able to input the stuff in the mainframe computers. And anyway, I handed in my forecast, but with the forecasts, you also had to write something in support of why you you forecasted these particular numbers, so that he knew you just weren't pulling numbers out of the air. And we put a lot of time into this, I remember. Handed my forecast, and then about a month or so later, the professor compared your forecasts to the actual numbers that came out. It was maybe a class of about, 30 students or something. I did the worst. My forecasts were the absolute worst, okay? But he gave me an A on the paper because he said, your methods, were sound. I just didn't guess right, It's like the guys who were trying to pick the spread Sunday morning before the football games. You try your best, but you just don't know what happened. Well, as it turns out, this was Professor Schiller who went on to win the Nobel Prize in Economics 25 years later. Mm-hmm. What I learned, besides the course material, is that economists are great at explaining the past, but don't know a hill of beans about predicting the future. And so that's what I learned from Robert Schiller, and it greatly influenced me even today when it comes to investing, and you're trying to figure out, well, how much is a company going to make? And of course, I apply my accounting skills there, and where you think the stock price is going to go, and what the P ratios, and at the end of the day, these are just forecasts, and the true answer comes from how does the market react to these forecasts. Now, after a while, I've developed, a sixth sense. I call it my gut feeling. So, I pretty much can forecast in different ways the way in which the markets will move based upon, economic or company, financial releases. But that's the kind of stuff. Those were my mentors, and there was one other important person, a fellow who I work for, Greg Van Kipnis, and he worked at Morgan Stanley, and then he took me to NatWest for a few years. And this gentleman worked in the group that developed the first black box trading model, which now is all over the place on Wall Street. But this was the group that really founded it. A whole bunch of PhDs, and a famous hedge fund manager came out of there, D.E. Shaw. Mm-hmm. But Greg not only greatly influenced me, he's still a mentor, and we talk every occasionally.
That's great. You've had your business almost 20 years after what I mentioned stops at Merrill and Morgan. Why did you start your own business?
Well, just so you know, Morgan came first, then Merrill, and
Mm-hmm.
I was at Merrill on 9/11. After 9/11, I had a wife and 5 kids and 2 homes and everything else, and I just said, I'm tired. I'm tired of the travel. I'm tired of the politics, and I'm tired of working hard to benefit other people. I want to be able to be more entrepreneurial. And so everybody said to me, and I have a good friend, Mitch, who's a human resource a consultant. And we sat down with other consultants, and we determined that, you know what, if I'm very good at investing for myself and my family, well, why can't I do it for other people? And I certainly had the skill set, I had the background, and so I took that chance. My father-in-law, who's a great influence on me, also he's it's interesting how I met my wife less than 6 months after my father passed away, and 10 years later we got married. But so my father-in-law basically is my second father, and he told me a story about how he was working as a mortgage broker, and one day he came home and he said to my mother-in-law, may she rest in peace, he said, I'm done, we're starting our own company. And sometimes, you know, that's what separates the winners from the losers, the people who take those risks. And I decided at that point in time, you know what, let me take the risk. And I did.
How have you adapted to the changes that you've seen in the industry over the years?
Oh boy, there's been so many. I think what you have to do is you have to accept them and not fight them. There are too many people who try to fight them. I live by the letter of the law, so I don't try to play games. And another thing I actually learned from a gentleman who I worked for at Merrill Lynch for many years, he said, Scott, let somebody else take the last nickel off the table because they're going to do something stupid to make that last nickel. And so I don't worry about that last nickel. Leave it for somebody. I'll take 95 cents. And so, if there's a rules change, regulation, and it affects the way in which I operate, well, then I modify the way in which I operate. I'm a pretty smart person, all right? In general, the regulators are not trying to shut anybody down. They're trying to make a more fair marketplace. So you just adapt. And I've had to, over time, change the way in which certain strategies may have been executed, or I've had to change perhaps, the strategies themselves. For instance, for many years, I was well known for my investment skills in restaurant and food stocks. And I had a separate restaurant and food portfolio. But things changed during the pandemic. And so I closed it down. Whatever food stocks I thought were worthwhile, I merged into our growth portfolio. And then about a year or so later, I re-engineered it into a consumer discretionary portfolio, which we launched earlier this year. So we have some food and restaurant stocks there, but we also have retail companies in there. So that's the way in which I react to changes.
Yeah. How have you chosen to grow your business? Because some people just want to be huge, and some people want to do this, but I think you've gone about it differently.
Well, I grew my business through personal referrals, through people who read me on thestreet.com, where I wrote for 10 years, and certainly people who have seen or heard me in the media. And I grew the business quite well for close to 20 years. But I realized, about a year or so ago, that I was running out of bandwidth, that my ability to do what I do on my own has reached its limit. I also realized that I need to expand the potential pool of clientele beyond just the individual high net worth investor, and maybe get into the institutional realm or the semi-institutional realm. And I realized I was spending too much time just buried in paperwork. So I worked with a gentleman by the name of Eric Edson, who's a business consultant. And we shopped around to several firms, understanding that I needed to, have someone who would really look after the regulatory aspects of the business, someone who would help with the documentary aspects of the business, and someone who can help me market and introduce me to clientele that I normally would not be in contact with. And we certainly looked at several firms, and Benchmark/Kingswood won the beauty contest, and that's why I'm here talking to you today.
What were some of the pieces that were important to you as you looked in making this move?
Well, I pretty much said it before. I mean, what was important is that I needed a company that had a well-established infrastructure.
Yeah.
Okay, I think that's very important. I didn't need to join a company that was first getting into the business, and there were a few of them that wanted to get into the business or were getting into the business, but I needed a well-established company.
How has that transition gone from doing that to joining Benchmark? And
well, there's a few ways of answering that. The transition took a lot of work, and another part of the process was I realized I needed to hire someone. I hired at least a consultant to help with the transition, and I think we're going to bring him on full time, and he's an energy expert. He was an energy analyst, and I think we launched recently an energy portfolio that he'll then manage when he does come on full time. My only knock in the process, and it hasn't been perfect, is that you didn't have sort of an organized booklet, if you want to call it, or document, which said, here's what has to happen as you're merging your business into ours. I would have liked to have that. Mm-hmm. And I did speak to senior management about it, and they took my comments very seriously, and I think they are going to write something that so when someone comes in the future, they can say, here you go. Here's here, look at this document. These are the people you contact for these things. These are the people you contact for something else. Here's the operations people. Here's the regulatory people. And this is what you have to do. This is the process by which things take place. I don't know if you ever saw The Prophet on CNBC, but he always talks about process and procedure
and people.
And yes. And they certainly have the people here, but that process at least wasn't codified, and I think they will in the future. And I certainly was very patient. I think we could have done it faster, but you know what? We still hit our deadlines, and I would say we're probably 99% transitioned. And now we're ready to take the partnership, if you want to call that, to the next level, which is, hey, let's start marketing Scott and building a new website and trying to raise assets and leverage off of Scott's experience and intelligence, and so that's what we're focusing on next.
I was going to ask you what made them win the beauty contest, but I think you just answered that question.
Yeah. Yeah.
So what does the future hold for Lakeview?
Well, a few things. First of all, I'm looking to expand our asset under management, level, and I think that in the next few years, we'll expand that rather rapidly. I've been very good, like I said, at building the business by word of mouth, and I've also been very good at building the business through my performance. How long you can continue to bear the burden of building by performance is very difficult. But you always strive to get the best performance possible. But you need to get fresh money in, and I've been pretty good at getting fresh money in. But now I think we need to look at a much larger pool of investors to get that fresh money in. And I think we're going to expand our assets under management. I can see it doubling by the end of 2022, and then maybe doubling again by the end of 2024. So that's one thing that I'm looking at, and certainly bringing in other talent, to help me, manage the money and maybe introduce some other strategies potentially. Another thing that I'm considering is starting up as an adjunct to the investment management business, a financial planning business. It's just something that we're missing. I do financial planning, but I do it in kind of a one-off, one-on-one with clients, and they'll call me up and I'll help them with a lot of the stuff that typically a financial planner would. But it's whatever you want to call it, ex parte, if you want to use a legal term. There's nothing formal in the process. I want to formalize it, and so I'm looking into the buy versus build aspects of having a financial planning business. I already have the name for the financial planning business, by the way.
Don't say it.
I'm not going to say it. Maybe that'll be a discussion for another time, or another website you can build for me. But and I'm certainly my daughter, who's getting her MBA now, she has an open offer if she wants to come in and help to build that financial planning business and learn other aspects of the business. And I'll say this: I think it's very important for me to get a woman into the business. Mm-hmm. And I think it's very important for me to get a millennial into the business. Okay, I mean, most of my clients tend to be 50 and older. And I want to start getting people while they're young to invest. I've instilled that in my children and my students when I was teaching at the university. All of my kids have to pay the investment tax, which means that they have to save some money and invest it. Even my son, who's still in college, says to me, "Daddy, let's put some more money into the market, into my account," and we do that. And except for the kid in college, they have enough money to put a nice down payment on a house, much like Dad did with their mother.
With his 50%.
Yeah, I can't say they can get to 50%, but you know what? They'll have a healthy down payment.
Scott, you live a full life. You got 2 homes. You're in 2 different cities all the time. You raise racehorses. You run racehorses and win. And I know you're an incredible collector of memorabilia, which I've seen. So what's your most prized piece?
Well, so the memorabilia collection started in our house in Bolton Landing, which overlooks Lake George, New York, and that's where we spend our summers. And then when we bought the house here in Las Vegas, it expanded to there, especially with the Golden Knights joining the NHL, and we're Golden Knights season ticket holders, and we're also Raiders season ticket holders. But I guess the piece that sentimentally has the most value to me goes back to a story in 1998. My oldest son said, "Daddy," he said, "the Yankees are having Beanie Baby Day." And it was, if you remember, Beanie Babies were the hot thing back then. I said, "Sure." I worked at Merrill Lynch and worked on Wall Street. I made a few calls. 12 tickets landed on my desk. So my wife and my oldest son and myself, and I don't remember who else sat with us. I think it was one of my son's friends, sat right behind the visitors' dugout that game. And then my sister-in-law and I think my daughters and my niece also had 4 tickets. And then I was coaching Little League at the time, so I gave 4 tickets to the fellow who coached with me, and he took his family. It was about the 8th inning, and our 2 younger sons were at home with my in-laws. And my wife said to me, she said, "Scott, this game's real boring. Nothing's happening." I said, "Do you have any idea what's going on?" "No, no one's getting on base. No one's doing anything." That was David Wells' perfect game. So I happened to enjoy photography, and I had my 35 millimeter camera with zoom lenses and everything else. And I got a picture of the team hoisting David Wells on his shoulders and marching off. He didn't look at the camera because he was looking towards the first base dugout. But that's all right. I got them carrying him off. Then I got pictures of the scoreboards, the one that had all the zeros going across, and then on the message board, David Wells had just pitched a perfect game. And David Wells, we got David Wells to sign that picture of him, being carried off. And then I made a big montage with the pictures I took, the pictures he signed, a ticket from the game, and then they gave out Beanie Baby cards along with the Beanie Babies. So that whole montage is framed together, and sentimentally, that has the most value for me. Financially, I have things that have more value than that, and I've just acquired a few in the last few years. I guess as I've made more money, I've decided to spoil myself, especially as I turned 60 a few months ago, and my father-in-law. One thing I had to fill in my collection. I have a lot of Yankee stuff. Whitey Ford and Yogi Berra and Mickey Mantle. So I got a lot of Yankee stuff. I had nothing with Michael Jordan. Mm-hmm. So I wound up acquiring, and I these days I deal with a reputable memorabilia dealer. So my father-in-law bought for me as the gift for my 60th birthday, and you saw this in my office, a basketball signed by Michael Jordan, Magic Johnson, and Larry Bird. the three big stars of that era.
Yeah.
And then recently, I just filled in the other part of the collection that I needed, and that was a Wayne Gretzky signed jersey, and that's now in for framing.
That's fantastic. What a perfect way to end the podcast. Scott, thanks so much for joining us. I'm sure we'll do this again.
Oh, my pleasure. Thank you for having me.
Please follow us for all the latest updates on Twitter, LinkedIn, and Facebook, all at Advisorpedia. For everybody at Advisorpedia, our producer, Jakey Beard, and the Permission to Succeed podcast team, this is Doug Heikkinen.